Okay, so welcome to another session of FX Street webinar. My name is Yang CMT, and also editor and chief technical strategist at fxtimes.com. So I'll type in my website there. So today we're going to spend this hour looking at some technical developments in the Forex markets. I'll also talk about some of the fundamental backdrop and upcoming event risks we should be monitoring for the upcoming couple of weeks. So without further ado, I'll get started with the euro dollar. I guess I should just introduce myself a little more for those who haven't come to my webinars before. I've been trading for about 5 years, been an analyst for a little longer, and I focus on the technical aspect of the market. Here you'll see me use simple technical indicators, though. Even though I'm mostly a technician, I don't use too many advanced and complicated technical indicators. I find good trading opportunities and ideas and understanding of the market from just some of the basic indicators, and really watching price action. You see me put on the 200 moving average and some of the smaller moving averages here. I have the RSI, standard 14 period RSI, and that's pretty much it. I used to use the Bollinger Band. I don't use that as much anymore, so I don't even put it on because I believe if you're going to use a tool, you're going to use it all the time. Otherwise, you can't just pick and choose when to look at it. Although there are times when an indicator doesn't really tell you much, but my point is with Bollinger Band, I didn't always use its signal, so I decided to just focus on price action, momentum, and trend strength. And you can get that from moving averages, price action, and an oscillator like the RSI. So in the euro dollar, I'm going to look at the 4-hour chart and maybe the daily chart just to get a general idea, and then I'll get into the most recent development. So in the daily chart, you see the market was bullish since July last year, two upswings, and then we had a downswing since February, upswing in March, and then again another swing down starting in May from the 1.3240 area. Okay, so now we're down here. We established a 2013 low here at 1.2744, and we're pretty close to it. We came down to 1.27, a little bit lower than 1.28, like around 1.20. Let me see. Let me just. So the low here was 1.2795. So that's our most current low here. But you see our 2013 low a bit lower. Okay, so as I just jumped down to the 4-hour chart now, and you see in the 4-hour chart we actually started consolidating after the market made that 2013 low, and the outer boundary of this consolidation is basically 1.28, or you could say down to 1.2744. Up to 1.32, or you could say up to 1.3230, the high here in May. So this range reflects the market's indecision. Now, it's sort of when it was falling, it was pricing in the Fed's readiness, the Fed's making the next move in exiting quantitative easing, and we haven't gotten any strong confirmation in that direction. Last week, Bernanke talked about, he warned us against premature exiting, premature tightening of policies. So, for me, that was more of a way for him to hedge against what market expectation is. He doesn't want to, go out there and just tell everyone, oh, we're going to exit. We're ready to exit. He wants to take it, he wants to take it slow, and during the discussion there was a lot of mention of employment, so we're going to have to we're going to have to monitor employment carefully, and I'll get to that. But since Bernanke didn't have a strong confirmation that we're ready to exit QE, the market has consolidated further, and we see a little bit of congestion. And you also see a bit of congestion even from the outer boundary, right? We made a higher low here, and then here we couldn't come back up to test this high. So the market, it's indecisive, and that means it's looking for another fundamental or another fuel to push it into one direction or another, but it's stuck in this range between roughly 1.32, 1.28. You could also expand the range down to 1.2744 or up to 1.3230. Now, to break this range, let's talk about this week. So this week, we are in a sort of the bottom half of the range, basically between 1.30 and 1.28. So 200 pip range, congestion. Okay, but and if you look down into the 1 hour chart, you see even more congestion as the market creates higher lows here, lower highs here, and the market's gotten very quiet in this holiday trading. It's Memorial Day in the US, so the US session is not as active. Okay, now what is going to help us help this market push out of this range this week? It's possible that the GDP on Thursday could help in that direction, but it's only a preliminary GDP. Still, it's the first reading for the first quarter, so that could be an important clue to whether the Fed is ready to exit. If it's a good number right now, it's it's expected. The forecast is 2.5%. Okay, so if it's more than that, we could have a bit of a further U.S. dollar strength. Okay, but to me, that's probably not the most important at the moment. To break out of the larger range, it might help us break out of the smaller range and either break above 1.3050, or if it does break below 1.28, we should still monitor the 1.2744 area as support, because next week we have the non-farm payroll next Friday. So it's still a week. It's almost 2 weeks from now, and anything can happen in about 8-9 trading days. So but the anticipation for me is that the non-farm payroll is going to be the key for the market to break out of this range. Okay, this week we have the GDP, which could bring us to either key resistance around 1.32 or to key support around 1.27. 1.2744, which is the 2013 low. Okay, so that's the euro dollar. It's consolidating, and it's consolidating ahead of key event risks. So you should pay attention to those event risks. Pay attention to the fact that we have a range. We have, and also, if the market stays in the bottom half of the range at the GDP, that means the market has more bearish bias. Okay, and sometimes you'll see the market pricing in the non-farm payroll, and I would say there could be a break even before the non-farm payroll, but I would like to see the market's reaction after the non-farm payroll to either confirm the break or establish that the break is the false break. Alright, so that's the euro dollar. Pretty general, pretty simple assessment at the moment. Not much trending going on in the short term, and therefore we should wait and monitor those key event risks. So you see that even though I use the technicals to understand price action, I also monitor key event risks to help me help me with the timing and also confirmation of breaks. Okay, so this is we're anticipating break of a consolidation in the short and medium term. Alright, so I'm going to move on to the pound dollar. If you guys have any questions or any requests for currency pairs that you want to look at, let me know in the chat. Otherwise, I'll just move on. Here is the pound dollar, and we're actually seeing some moves right now. I didn't see this actually this must have come in the last 10 minutes in this hour. I didn't see this break yet. But let me just rewind a little bit. We had, after establishing a 2013 low here at 1.4830, we saw a rising channel until May, when we had the market find topping at 1.56. Okay, and this is, you see the market rising, you see the market's going sideways, and then you see a break and the market coming down. So this was very, I would say, very it's price action that you can clearly see. It's not too choppy. You have choppiness within the trend, but the overall direction was pretty clear here. After the topping, we had the market come down, test this rising trend line, and then break that and continue to decline. So the pound dollar is quite bearish right now in this 4-hour chart. You see the RSI dip below 30, which is a sign of bearish momentum, and then if the RSI fails to break back above 60, the bearish momentum is maintained, and when you come back to 30, it shows persistent bearish momentum. So here again we have this relief rally from last week, and we came up to about 1.5160 area, and we're coming back down. The RSI didn't even reach 60, and if the RSI pushes back below 40, it shows that the bearish momentum is still there. If the RSI gets caught now between 40 and 60, that would show consolidation. But if the RSI gets pulled down below 40, price action is likely to pull down below some of these local support pivots and show continuing bearish bias, and that would continue to put pressure on our support here that held last week. These previous couple of support pivots above 1.50. So if we break below 1.50, okay, let's say the GDP was a positive surprise and the US dollar gains across the board, we can see the pound dollar break below this low, and that would open up the 2013 low. But for me, again, the non-farm payroll will probably be key to whether or not the market will continue to lower below the 2013 low. The question right now is whether the market has put in the low for the year, and I think that non-farm payroll will help to answer that question. Okay, but for now, for this week, we do have the GDP report, and I think we do also have the Bank of England meeting next week. So again, next week it's for pound dollar you have the non-farm payroll on Friday. Before that, on Thursday, you have the Bank of England meeting. So that's going to be a key sort of end of the week event risk for next week, and those two should help us determine whether or not the market should continue lower below the 2013 low. I think if we break this 2013 low, we could set off another stage, another phase of pound dollar selling. So if we go on to the daily chart, you see we had this one swing here in 2013. Had a correction. You could say that's a flag pattern, right? And when you look at it from the daily chart, this rising channel could be a flag pattern. And if so, if this break continues, we could anticipate another swing. And when I talk about another phase, we could have been already in that phase, and a break below 1.4830 could continue that, confirm that we're still in that second swing down. Okay, if you look at the weekly chart, okay, that second swing down would come back to these lows. So you got to watch these lows. I would say, the swing projection is quite aggressive. Okay, so we might want to scale it back, at least limit it to this 2010 low here at 1.4225. Okay, that's getting ahead of ourselves a little bit because I'm talking about the next couple of weeks and what we can anticipate, but the break here could open up another bearish swing in the medium term in the next month or so. Okay, so now I'm going to come back down to the lower time frame. We saw a 4-hour time frame. All right. Okay, so let me get rid of this swing projection so you don't get confused. And when we go back down to the 1-hour time frame, we see this break of a little wedge consolidation here. So it looks like the market continues to put pressure on these lows here around 1.5025. But again, today is a quiet day. When it comes down, if it comes down to this 1.5063 pivot, you see this resistance pivot, support pivot. Let me magnify this a little bit, and then you see here resistance. We cracked it here a little bit, but it's still after the support, and here we have support. So around 1.5060 to 1.5065 would be our intraday sort of support area to monitor, because there doesn't seem to be enough fuel yet to push lower. Unless you never know. You can always get these surprise headlines, you get unexpected headlines about certain bank forecasting poor GDP or better than expected GDP. In any case, I think before the GDP, this low, especially these lows, could hold, and intraday I think 1.5060 could hold as well. And if you look for an intraday bounce, I wouldn't look for it to come back to these highs or even or to test these highs up here. That could happen, but in the context of a non-trending market, without a quiet market, without much fundamental fuel, my conservative estimation would be just a rally back towards some of these, somewhere in this consolidation area. I mean, not consolidation, but this sort of topping area we had here. So maybe the middle of it, that would be around 1.3130. Now, I wouldn't expect this market to go up. If it does, then that's fine. But in terms of when you make a trade and you expect, you have to have some kind of expectation of where that trade might have to be wrapped up. You might have to exit, and you're doing that for your reward to risk analysis. You shouldn't expect the reward to be definitely back up to our 1.50, 150, 60 high. That would be a little bit aggressive, but that could be a potential reward. But I think a conservative expectation is down to 1.3130, maybe even 1.3115 area from the 1.5060 area. So that's an intraday anticipation for this pair if it does come down to these support levels. Okay, so the pound, again, the US dollar side, GDP this week, non-farm payroll next Friday, and also from the pound side, the Bank of England interest rate policy meeting next Thursday. Okay. Okay, let's move on to the dollar yen, which last week we saw some topping action here. We saw the market break below this rising channel, sort of ending channel, capitulation channel, whatever you want to call it. Then the market kind of topped off and fell below 101. But really, in the bigger picture, this market is still bullish. It might be bearish in the short term, near term. Okay, but overall, if you look at the 4-hour chart, it's still bullish, right? The momentum might not be as bullish anymore because you see the RSI drop below 40, and recently the RSI hasn't been holding above 40, so it's not a very bullish market in this time frame, although you do see price higher highs and higher lows. Really what you had here is one swing, a consolidation for a month below 100, and then another swing to break above 100 that held below 104 and topped off at 103.72. So you had two swings up, but choppy momentum, I would say. Okay. In those, if you think the market is bullish but choppy, what kind of strategy do you think is appropriate? If you anticipate a trending but choppy market, in this case it would be buy on dips, right? If you think the market is trending but not choppy, you might have to buy on breaks. Okay, in the very short term, for example, this here, okay, you saw a market rally, consolidate, and break, and this is the type of trade that you might need to catch on a break, because after consolidation, you would expect a break. After consolidation, and you see a break after consolidation, you can expect the market to extend in the direction of the break, especially if that direction is in the same direction as the prevailing trend, which is a strong uptrend, as you can see in the daily chart that goes all the way back to October and November. October it started to bottom out, but November is where it started to really take off. Okay, so I'm still bullish. There are traders who can fade this, of course. This is the market was a little bit overbought in the 4-hour chart, and you do see a bearish divergence. But I'm not that type of trader. I don't really if I'm going against the trend, I would do it after a rally back up to these highs. That's because you have an uptrend, and if the market is going to reverse, there are two ways it could reverse. One is that it would just completely, make a V-shape, inverted V-shape, reversal like this, right? But the more likely scenario, in my opinion, is that the market will need to consolidate before it breaks. So during this consolidation, you want to find out where the boundaries are, and if the market started to consolidate, then natural boundaries would be up here for the resistance and support. We're not clear yet. We have some ideas of where we could find support. For example, we have a rising trend line here, and we have the 99.90 to 100 barrier down to the 99.90 resistance we saw in April. So that could be the next support. But as far as trying to short it now, I wouldn't do it until we come back up here, because look, if it would be a smaller risk, right? Because if it breaks above, it kind of kills that bearish outlook, because the market continues to make highs, higher highs and higher lows, and shorting it from up here would be going against the trend. You don't even have a short-term trend or a short-term signal that it would that the market has exhausted. Okay, but here this is pretty much the short-term signal that the market has exhausted, and if that is true, then if the market comes back to these highs, there should be resistance there. Okay, so and also for a break to the downside, I wouldn't like to play the break neither. Okay, because again, it's going against the trend. I will again wait for a bounce. In this scenario, I would think that the market has established a top here, and I wouldn't necessarily expect the market to come all the way back up here. even though if it does, be prepared for it. But I would have another trading signal if the market comes back, even to the lower. I would say around 102, or if you do a Fibonacci retracement of that swing, look for 61.8%, between 50 and 61.8%. Okay, so that's how I would approach this if I'm looking for the downside. But if you follow the trend, let's go down to the 1 hour chart, because we see support here, right? We'll go down to the 1 hour chart. We see the market, give a little support. It might not be as significant today because of holiday trading, but nonetheless, in the very short term, you see support, and then you see a pivot here around 101.30. So I think if it breaks above 101.30, let's see. Okay, this is what I call a counter trend line, and that's already broken, but it's broken sideways. If it breaks above 101.30, then it's breaking the counter trend line to the upside. Now this is a counter trend line because the trend line is against the trend, which is bullish. So a break of that is a sign that the market might continue in the direction of the trend. And again, this could be the GDP could be a factor here. I think the market could break 101.30 before Thursday. It's a very small range here setting up, and if it breaks, though, I would say my bullish anticipation from that break, due to the fact that we have these key risk events for U.S. dollar and Japan as well. I think this week. Well, from Japan, there aren't that many key, like, central bank GDP type of or employment type of indicators coming up. We do have CPI this week, inflation. We have. I think most of the fuel will come from the U.S. dollar side. As far as scheduled event risks go, I don't want to. I don't want to tell you, not to look for any Japanese news, because hey, if Bank Governor Kuroda says something like, our efforts, our easing efforts seem to have worked, and I think we could scale it down. Something like that could be a major Japanese yen strength. Okay, but status quo for now is Japanese weakness due to the Bank of Japan's very aggressive easing policy that they are maintaining, that they are executing. Okay. In any case, if Japanese yen weakness continues, we have good GDP, we could continue up here. And the trend is already bullish, so I wouldn't. So the break of this even before the non-farm payroll is possible. Okay, I wouldn't. But I would still look for a chance, at least a short-term resistance here. If not for a reversal, we could come back to the middle of a set consolidation. So right now the set consolidation boundary is 103.72 down to 100.66 or something like that. So if I look for resistance there, my first anticipation of a target would be down towards the middle. Now, in this 1 hour chart, we see that we see the 200 moving average flattening, and that's sort of the guide for mean price action. So when we're talking about reversion back to the mean, because because the market is sideways and it's at the boundary, then we're really talking about reverting, the market moving from the boundary, especially if it's oversold. We're looking for it to come back down, resolve that oversold condition, and come back down to the middle where the price is sort of quote-unquote neutral within this range. Okay, so that would be my anticipation there. But a break for me, I would be more aggressive to the upside than the downside. Okay, just because the trend, that's one way to say the trend is your friend, to be more aggressive with the trend than against the trend. But there are people who say never go against the trend. I think that's a little bit too strict, because there are sometimes opportunities that you can get when you catch, quote unquote catch a top. I'm not talking about catching the exact top here, but I'm talking about price action showing you a top and then shorting from the respect of that top for some correction against the trend. Okay, but again, aggressive with the trend versus against the trend. All right. Okay, so let me just answer a couple questions. Hello, fan. Were you part of FX Times earlier? I was and still am. So you could see all my analysis at FX Times. But I definitely, I've been doing that for quite a few years now. So, okay. So next question: horizontal support resistance important, or trend lines channels important? For which market gives more importance? Well, I believe that whether it's a horizontal or slanted, sloping trend line, the more the market reacts from it, the more it's important. Okay. For example, this trend line here, for me, is not that important because you really have just projection from 2 points. If we had another point here falling like that, okay, like the market showing reaction like that, then if there's a break, I believe that break is more important because you have a very well established trend line. Then the break is more important. Right now it's not as important, and that's why I think it has to be coupled with another break above this 101.30 pivot. Okay. I can't generalize whether a horizontal pivot or resistance support is more important than a sloping trend line. But what you want to gauge the strength with is how the market reacts to those trend lines. Okay, and the more aggressively the market reacts to those trend lines, the more important the break of the trend line is. Okay. There are times when, let's say, I have a range here, and the range resistance just keeps on holding the market. Okay, let me go to the euro dollar here. Let's say this support here around 1.28 continues to hold as support. Okay, then the next time, let's say it held twice here and then 3 times, and the next time, the 4th time, it comes down here. I might respect that support as well and try to go for try to go long. But if that fails and the market breaks that support, I would immediately turn short. Okay, so that when a level or a line becomes very important, I would be ready to go on both sides of it. Okay, I hope that's clear. How to play key resistance and support, and basically that's how I do it. Okay. Any opinion on Aussie Kiwi? Seems a bottom channel. Not sure of relative strength. Okay, I'll take a look at Aussie Kiwi. Okay, so we looked at for what I think is the top 3 most important pairs, most traded pairs at least: euro dollar, pound dollar, euro dollar yen. So I'm gonna go to your requests. But even if you don't have any requests, I'll have some other pairs to look at as well. But Aussie Kiwi has been a little bit off my radar recently. But I'll bring that up now. It must be in my deleted. Okay, we'll just create a new chart. Okay, where are you, Aussie Kiwi? Okay, so Aussie Kiwi, let me go to the daily chart to look at the higher time frame first. And from the daily chart, you can clearly see a bearish market, although it's been kind of choppy as the RSI has been able to swing back and forth between 30 and 70. So again, if that pattern remains, then selling on a rally could be a strategy in this pair, in the daily chart. Okay, here's some recent trend line here. Okay, you see the market sort of accelerate down. You've broken this projected trend line support as well. So it's quite a bit of a extended market to the downside in the daily chart. Let's go to the weekly chart. Okay, so in the weekly chart, it does give you some idea that the market might be a little bit extended to the downside. And if you look at this swing projection, we're pretty much near that swing projection, ABC correction. Okay. When you look at this market from the weekly perspective, it could be coming down to a key support somewhere down here. You see, basically I want to point out this bottom action here. Okay, this bottom action, back in 2004 to 2006, 2007. After we had that, we still had a choppy market, but it was bullish. You see the moving average going up, price mostly holding above the moving average, but now it's broken below the moving average. So I would say, that bullish bias is over. Okay, it's more of a sideways market in the weekly chart, right? So the lower it goes, the more we can start to expect the market to sort of revert to the mean. Okay, but let's see. I would start looking for some type of bottom action for some short to medium term correction against our decline so far in 2013. Okay, so with that in mind, let's go down to our lower time frame. So let me just I've been sort of just saying whatever's on my mind, so let me just recap a little bit. We're in a sideways market in the weekly chart. Okay, we're in a bearish market in the daily chart since 2010 really, but this bearish market could be coming to some key pivot area around 1.18. So if we see some support forming 1.18, 1.19 area, I would consider a break of that support to the upside to signal a corrective rally. Okay, so let's go down to the daily chart and see if we're getting that. And in the daily chart, we're not getting that. Okay, we're still very bearish in the daily chart. You might say, oh, we have a little bit of a bullish divergence. Okay, look what happened here when we had a bullish divergence, right? That's a very valid way to think about it. And if you trade this, let me tell you, this is not the trade I would take. Although obviously, if you did take it, you had this rally and have been pat yourself on the back for catching that bottom. But again, this is against the previous trend, or at least even though it's a choppy trend, I would either avoid it or put very small position in trying to catch this bottom. For me, a more likely trade would have been here after the market broke above this top, came back down, and came up, sort of bottom action. And then I would look for the market, at that point, before that high was made. My conservative expectation would be, somewhere in the middle of this consolidation, and also matching, coincident, or in confluence with a projected trendline resistance. Okay, now we're back here. Again, if you play this, and the market does end up giving you good profit, that's you can pat yourself on the back. But for me, that's something I don't try to catch. You could see some type of, I would prefer some type of sideways action and then a break. Okay, even then, you could get whipped. Like here, you see this little price action here. Oh, it came back down. You had a pin, and then a very strong push to the upside. That must mean a false breakdown, and then that must mean a reversal, and you didn't get that. But that's fine. But that's sort of the case in point here. You don't want to be too aggressive going against the trend because the momentum is still bearish. And there's actually a signal here created by the RSI. Let me just match the tops here. It's called the negative reversal, where you have a higher RSI high but a lower price high during a downtrend. Okay, and that would suggest the momentum is still bearish. We can still have another swing down, and we are pretty much getting that from this resolving this negative reversal signal. So here, lower high compared to this. So another swing down. Again, I would therefore anticipate the market to come down to 1.18. So yeah, look for some kind of bottom action. Here we got whipped, sure, but I would still look for that bottom action. If you look up here, this was a very quick bottom action. Let me go to the 4-hour chart so we could see the anatomy of these quote-unquote bottoming action, right? In the 4-hour chart, now when we come down to the 4-hour chart, you might be able to be a little bit more aggressive, okay? Because back in this, you had a wedge. And when you broke the wedge, came down, respected it, and break to the top, that's a break. That's your bottom. Okay, and you had a little consolidation here, another break, consolidation here, another break. So there were a couple of chances to get on this. If you go in the 4-hour chart and look for that bottom. But if you were just looking at the daily chart, I wouldn't be able to get in this. 4-hour chart allows you to see the anatomy of price action in the short term and the breakout. So here in the 4-hour chart, possibly looking for some similar type of setup. Okay. Let's see. Okay, so we see a break of this. Because it's against the trend, once again, I would wait for a little bit of a pullback. Okay, and go with the respect of these lows. And if the market does also respect it, then great, you're on the right side. But if it doesn't, you would risk a little bit less than if you had entered on the break, right? If you entered on the pullback, and then you see some reaction and get on it. But if that fails, you risk a little less than if you entered on the break. Okay, so that's your Aussie Kiwi anticipation. Now we're looking. We know that we have a channel support that's broken. We know that 1.18 could be a key support. So knowing that we have some support here gives us a little more confidence to play against the trend. But still, if you're going against the trend, you need to see the break of some bottoming action, at least a falling wedge to break. Okay. I think if the market breaks above this high here, that's the origin of the wedge, and you see this high matches some of these lows, that's the next key pivot to break. And above that, we could come up to the next pivot, wherever that is. Okay. Alright, so that is the Aussie Kiwi. Let me look at the Euro Yen. Okay, Euro Yen is also a pair that was very whippy recently. And I remember the last webinar I was here, we had so sometimes we were here. Okay? And that's good, because a lot of times when people do webinar, I guess like we like to show the good trades, right? But you also have to show when the market goes against you, because that's really when you trade well, it's easier to manage the trade. You kind of let it go, let it ride. If you put your limit too tight, that might not be good. But if the market's sort of like pushing towards where you want to exit, you might want to just let it go further. So it's a little easier to manage your wins, both from a practical point and from a psychological mental point, right? It's easier. I was like, okay, so whatever, even if you didn't manage it most efficiently, you still might be happy because of the gains. But as a professional, you should leave emotion out of it, and even if you won on the trade and you see that you didn't do all the things you had to maximize the profit, you should not be that glad about it, and you should keep improving. It's about the process. It's not about the result of each trade. Each trade is just one little trade that's minuscule in your career as a trader. So you have to move on to the next one and keep building good habits and recognizing bad habits and trying to get rid of them. But in any case, we do have to look at a lot of the losing trades and know how to manage them. Here we had a breakout, and in this breakout I would trade the breakout because the market is in a bullish trend, right? The RSI for me is also bullish after it stayed above the 40 level. So for me, that's a sign of bullish continuation when the RSI here pushed above 60 as well. So that means momentum is maintained, and price action is in a breakout of a range. Okay, but we had this price action came back down and broke below our low here. So that, for me, some of these moving averages, some of these pivots here give me a clue. And I was holding this until it broke below 132. I held it a little longer, but basically below 132, it was sort of a break below the middle of this range. And for me, if it is to respect this range, it should come up from there. And you see some of the market participants trying to continue that trade, trying to respect the range in favor of the bullish trend, but obviously there was more bearish intent and we broke to the downside. So this trend, so now I'm looking at a wider consolidation. Okay, this now sets up, the momentum is lost. There's no, we lost that bullish momentum. We actually established a little bit of bearish momentum, although this is in the context of a sideways market. So if the next time the market comes back up to this area, I would consider shorting it. Okay, and you got a little bit here. Okay, but the pin here, price action here, should be a little bit disconcerting if you're looking to the downside. Okay, first of all, your trend has been bullish. Second of all, this bearish attempt, even though we were consolidating, we did respect this high here, and we came down and even made a lower low here down to 131. But the pin action shows you strong rejection there. The RSI was not able to get pulled back down below 40. So that for me is the market staying sideways. Okay, so when the market, let me put that high back. So when the market's sideways, right, from up here, remember I talked about reverting back to the mean. You wouldn't expect the market to come all the way down here anyway, but it was quick price action to bring you down there. Although for me, this was not high enough to catch it. I wanted it to get closer to 132.70, something like that. But in any case, if you exited in the middle here, that would be the reversion to the mean kind of trade. You might get lucky if the price keeps coming down and didn't hit your limit. You let it go and put a trailing stop, tighten your trailing stop since it's coming down to your range lows here. This is this is where you would expect some market participants to buy it, and we did see that. We did see an immediate rejection, and then the market continues to be choppy. So what are we looking at? If the market continues to be choppier and choppier with wider volatility, that could be a sign of topping. Okay, you basically have an expanding type of consolidation, right? You had some small consolidation, wider consolidation, even wider consolidation. Okay, and also you have breakdown of this rising trend line here. So it looks like we could have topping. Okay, but not so fast because the momentum is still. When you look at the 4-hour chart, the momentum is not bearish yet. We're still holding above the 200 moving average in this chart. And if you look at the daily chart, it is still very bullish. So as far as looking forward to the next week or two, I'm sorry for changing the chart so much. Okay, so I'm gonna stay on this daily for a little bit. Looking at the daily, you might want to look for a dip. Buy on the dip maybe, because yen pairs have been it's been successful with yen pairs, that strategy, buying on dips. But you might have to have some patience for it to come down to this rising trend line, maybe coincident with some other pivot level here. You see this area here, resistance here, support here, trend line support. Okay, so when you get a confluence of factors, you might get more reaction there to the upside. Okay, and for me, if I'm buying there, my conservative outlook would be up here. Okay, in case the market has gone sideways. Basically what that means, let me just translate that into trading management terms. That means when it gets up here, if it gets close to 131, I want to lock it in, make sure I lock in my profit, not just break even, but lock in some profit. If it got from 127.50 up to 131, you could lock in at least 100 pips of profit there. Okay, if it keeps going, that's great. If it keeps going but comes down and whips your stop, don't get discouraged. Continue to look for trade opportunities with the bias to the upside. You're not going to get, when we talk about maximizing your trade, that doesn't mean you're going to get every swing. Sometimes you'll lose a little bit from the top and bottom and catch the middle. but you sort of it's sort of a trade-off to not go from the top to bottom and only get the middle. The trade-off is that you don't get as much profit, you don't get the full swing, but the trade-off is that you get a little more confidence after the market establishes a top or establishes a bottom to catch that middle. Okay. Alright, so that's the Euro Yen, and we just have 5 minutes left, so I'm going to go quickly look at the Aussie dollar. I believe, do we have... Yes, we do have an RBA interest rate meeting next Tuesday. So again, GDP from the US dollar side, then next Tuesday, the RBA statement, interest rate statement, and then Friday's non-farm payroll again from the USD side as our risk, event risks for the next couple of weeks. But as far as price action, as far as technicals go, we've seen a very bearish market in the 4-hour chart. If we look at the daily chart, it's also like a waterfall pattern, right? It just came down, and this is one of those case in point of a support area that was very important. Okay, so here we had a break which whipped because it had a pin bar and then came back up. So it showed this support again. Right, this support area became very important. Okay, so you can buy off of it, and you can trade on the break of it. And here, trading on the break of it, it came all the way down below parity. So this is a very strong swing. We might get a little bit of support here from the 2012 low here, 95.80, and I think that's what's going on right now. We're getting a little bit of reaction, a little bit of support, but the trend is still bearish. However, we might see some short-term, very short-term correction because the daily chart is oversold. The 4-hour chart, I think it's resolving that oversold condition. Yeah, it's resolving it, so it's not as oversold. But if it comes down here again, let's say it comes down to the 0.9580 area, and it's not like a strong break, you might see a little crack. But if it comes back up, we're continuing to consolidate with bearish bias. Okay, so this is a market where it's not, for me, it's not a very tradable at the moment, but you could, there could be some counter trend trades which I would not recommend being aggressive on as always. Okay, but you could use some key levels like the 95.80 to 96 handle as a key support, especially if there aren't any fundamental fuel, any fundamental surprises. If you see, okay, we have a few days before the next key event risk and the market is already down here. My maximum bullish outlook, however, would be up to 97. This pivot, also, I feel like there's a projection here of some trend line, either these two or this two here would be very sharp. But my point is the market is still making lower highs. So I would, if I anticipate a rally here, I would still expect a lower high than the previous high, and we see this pivot here around 97 to be a possible near-term, short-term target for a counter-trend trade from 95.80. Okay, this is sort of where I would go against my rule a little bit, in that I wouldn't look for necessarily a bottom yet, but maybe if you look down to the 1-hour chart, you might find a bottom to give you more confidence. If the market comes down here, bottoms out and pops up, look for it to go to 97.97. Okay, so that's it for today. That's our hour now. Thank you guys for your attention, And once again, catch me at fxtimes.com for my latest updates. I'm not going to be that active today because it's Memorial Day and I'm taking the second half of the day off. So you guys enjoy your day if you're celebrating, or if you're trading, trade well and trade safe. And come and holler at me at FX Times or in Skype. I'm on Skype a lot, and my Skype ID is fan.yang.cmt. And I haven't scheduled my next month's webinar, but I'll be back next month, so I hope to see you all again. And also, much thanks to the FX Street team for making all these webinars possible for you guys for free. It's a great resource here at FX Street. Okay, and that's it for me. So again, trade well, trade safe. Bye-bye.